Hey traders, Stephen Quitzel here. It's Friday and we are getting ready for a nice Father's Day weekend. I wish all the good fathers out there the best. Have a great weekend. So we're going to dive deep into the market because, as usual, it's exciting. There's a lot going on. But I want to dive deep. I'm going to look at a lot of charts. We're going to start at looking at the overall market, and then we're going to move into some indicators that I like to look at to see really what's going on under the hood. And then we're going to look at some charts that are looking really interesting, maybe some potential opportunities to trade in, assuming that the setup is right. So let's really dive deep. You have the Nasdaq right here, and it's really looking like it's breaking all the moving averages, right? So you have the Nasdaq that was trading in this kind of sideways trading range, kind of had this little double bottom, this breakout bar right here. Let me inspect that. So the market, the Nasdaq, the S&P 500, it broke out on May 24th. Now I really like this breakout because when you looked under the hood at this breakout, technology was leading, discretionary stocks were leading, everything was leading in the market, and that really, even a few days up to it. So, it led me to believe that we're probably going to test these highs and break out, but that didn't happen. Clearly, after a few days, literally 2 or 3 days after the market broke out and the aggressive stocks were moving higher, under the hood, now the stocks continue to move higher in technology, but under the hood, all of a sudden, the more defensive stocks started leading, right? Utilities, and we're going to look at that, but it's not a good sign that you have a breakout and then it looks like it's working, but that's why you always got to look at some under the hood indicators, that sector rotation, to see if the aggressive stocks are going to continue to lead. So right now here, let me take this inspect off. Right now, the market reversed yesterday, which was nice, but on Thursday, but again, if you would have looked under the hood, utilities led the reversal, right? So it looked like the Nasdaq was printing a nice little candle reversal right here, finding support at that 50-day moving average. And then, but when I looked under the hood, utilities were leading and the more aggressive stocks were really not participating as much on the reversal. So sometimes that you want to look at that when you look at it for a potential bounce play, like, okay, when you get that, either that hammer or that engulfing candle or whatever kind of candle, that reversing candle printed, on the day of that reversal, what happened to the sectors, which sectors were leading. So I want to look at the S&P 500. Let's look at this. So I know there's a lot going on in this chart, but I really want to look at it because I've talked about these trading ranges in the past, right? You have 2015, and this was, the flash crash right here, August of last year, but you had this trading range, right? And the trading range was longer, but I wanted to use a shorter term chart. And then it just completely fell apart, and then you had this double bottom breakout, entered a trading range, and then it completely fell apart. Another double bottom breakout right here, and now we're in this trading range again. So really where I'm looking at drawing a support, right around here, you can see I really have this circled. Actually, let me take that back off. But right around this, the S&P has got to find support in this 2000 to 2020 area. If it breaks this level, I would expect for it to come down here and test these February 11th lows of 1810. We're really honestly, we're in no man's land. Whether we're in this trading range or whether we end up down here, we're really in no man's land, and it's not really a good place to be. And you have to be really, really careful. I don't know, I always say that, and I say be patient. But you have to be really, really careful and just pay attention to the sector rotation and what's going on under the hood. Because if it didn't break out, right? It broke out of this pivot right here. If you look over here, you have this trading range, and you have, the S&P tried to break this level, and it rolled over, and then it tried to come back, and then it just completely rolled over. Well, something different happened in this trading range. Is it tried to break this level, and it did, but the Nasdaq did not. So the Nasdaq did not follow suit. The Nasdaq rolled over, and right now, the S&P 500 is really looking like it's living under the blue line, which is under the 50-day moving average. So there's no support, then there's no trend. This short-term trend quickly failed. So I would really expect, and we're gonna look at some charts here in a second on the VIX, but I would expect probably another bounce at some point in time. But I would really be surprised if the market at this point in time, based on what I'm going to show you today, I would be surprised if the market breaks out to new highs and continues the bull market. I think we need to, and I would actually look forward to just a washout low, just completely, clean the decks, wipe the slate clean so we can re-enter another bull market. Because right now I'm just, with the sector rotation and all these trading ranges and the double bottoms, and it's extremely difficult. Now we caught this trend, that's great, made some money on this trend, but you don't want to get chopped up. And these volume bars over here, these are the volume by price, right? And it just goes to show you during different price points. So you can see between 21.20 and 20.20. Okay, so we have about approximately a 5% swing, maybe, right in this range. And you can see there is so much volume. And what this means is the institutions are trading heavily between 2020 and 21.20. And how I look at that is because every time the market gets up to this level, it rolls over. And it really needs to break through, and it needs to break through on convincing sector rotation. But the institutions, right, not you and me, the institutions are what move the markets. And every time the S&P gets up in these levels, the rotation starts to happen, the volume starts to happen, and it shows me the institutions are extremely nervous during these levels. Once it gets up here, the institutions are starting to rotate into the more defensive sectors. So it's something to be very, very aware of. And I'll show you just a simple way to always find out where the money is rotating into. But as of right now, defensive sectors are leading, right? We had aggressive sectors leading, and then it quickly rolled over, and now defensive sectors are leading. Now the S&P is under the 50-day moving average. So we'll see if it finds support around here. If it tests this level, I would expect it to bounce, but I would be surprised if it bounces and breaks out to new highs. I think based on the sector rotation, the odds are that it'll bounce and roll over. And I'm going to show you some data to back that up. So I want to look at a longer charts. So that was kind of the shorter term picture. Now this is the Nasdaq. This is really the 2-year chart. This is since the beginning of 2013, so maybe 3.5. But the Nasdaq has been, look at this topping formation. When you step back and look at the indexes on a weekly chart, right? You get rid of the daily noise and you look at it on a weekly chart, where you have the 40-period moving average, you have the 10-period moving average. It really looks like a topping formation, right? And it's just one large trading range, right? Where some 15% trading range where the market is just ping-balling back and forth, back and forth, back and forth. You're not really making any headway. Now, that doesn't mean that we won't break out eventually, because eventually we have to break this out, but we might break down first. But you could sit here and say, okay, I'm in this long rectangle pattern, right? And these patterns are not good if it's a topping formations, but you like these patterns, if there's been a long correction and now the market starts to base for a while and then breaks out. So you can see this level has really been tested several times over the last 2 years for the Nasdaq. You had October of 2014, and we really had a V-shaped recovery, and it just kind of grinded his way, chopped up a lot of people in 2015. And then you had a test of this level back in the flash crash, and then you had another test of this level back in February. So this level is extremely, extremely important, but nowhere between where we're at right now and this level is a good level to really try to trade in, unless you have a market breakout and the sectors are rotating nicely, right? Like we did on this trend. The market bottom, you had a day 4 or 5 breakout, and then the market went on a nice trend, and the sector rotation was backing that up. But nowhere down here is really a good place to be if we break the 2,000 level on the S&P. You can also draw a nice rounding top formation on this Nasdaq, and then it would really look like a topping formation. Also, you have to pay attention to this 40-week moving average, which is also the 200-day moving average. It's looking like it's trying to turn up a little bit, but for the most part, it's still trending downwards. And you have a series of lower highs, right? The Nasdaq never broke out to new highs. On this one, it rolled over. Now we're right here. You know, one could say this is another shoulder, and it's looking like it wants to roll over. That doesn't mean it will, but I'm being extremely cautious right now. And I'm going to talk about some more charts that will show you why. So let's look under the hood and let's look at the breadth indicators. Okay, so when I really look to see if we have a healthy market, I do really 3 checks, right? I'm looking at the price and volume first. Is the market moving higher, right? And if it is, I'm like, check. Okay, now step number 2, is the market moving higher in the aggressive areas, right? And if it is, check. If it's not, then it's not like I go out and sell everything, but I probably won't make new purchases if I'm seeing that negative divergence. If utilities are leading the market higher, I'm not going to be making a whole lot of new buys unless it's something completely unrelated like commodities. So you look at the sector rotation, check, and then I look at the breadth. Are a majority of stocks moving higher with the market? And if breadth is downtrending when the market's moving higher, that means there's not broad participation. And again, if I see this, I'm likely to hold off on any new stock purchases. It doesn't mean I'm going to go out and sell everything because price trumps everything. But again, you know, it is a divergence. So I wanted to show this to you. Now, this is the S&P 500. Now, this is the weekly chart, but you can see, right, this is the nice trend we had, made some money, had a breakout. It's looking like that breakout's failing, or we're going sideways, which means you could get chopped up. But now this is the weekly chart. On the daily chart, the S&P 500 broke to new, at least recent highs, right? At least for a day or two, and then it rolled over. However, you look at the breadth indicators, and if we kind of add an inspection right here, you can see that, okay, the breadth indicator, let's look at this 50 period EMA. The breadth indicator makes that high great. Now when it makes a new high, you can see the broader stocks participation, the number is lower, and that's not a good sign, right? That's kind of a warning sign when the market breaks to a high and the breadth indicator is breaking to a low or isn't breaking with that high, then you need to start to pay attention. And you need to, make sure you raise your stops. If you got some profits, maybe you take a little bit of profits on a couple and raise your stops to break even. Again, I don't believe in an all or nothing decision, right? I like to scale in and scale out. So as the market's working, I'm putting more money to work. And as the market's pulling back, because sometimes pullbacks are only 3 to 4%, right? I sell some stock. I hang on to the ones that are hanging in there as long as I can until I have to scream uncle and they're starting to break, key moving averages. And then I'm just really having to just get out of the way, right? Because the market is always right. People are usually wrong. Don't ever try to argue with the market. Over time, you'll do a lot better with that. So again, the breadth indicators was showing us early warning signs as this S&P was breaking out that there could be trouble ahead, and now it's starting to roll over. So let's look at some more indicators. Okay, so the gold line is the S&P 500, right? And it's kind of choppy, but the gold line is the S&P 500, and this black and red line is consumer discretionary versus consumer staples. And what that means is if the line is moving up, that means that aggressive stocks are outperforming, which is what you want to see. And if the line is moving down, that means money is flowing into conservative stocks. And all you have to do is do this XLY:XLP. Go to stockcharts.com. It's free. And you can quickly gauge what's happening under the market. You don't have to pay for that. So if you follow the gold line here, you can see So what I'm looking for, again, is a divergence. Just a simple way. I don't need a bunch of oscillators. Just kind of a simple way. So right here on May 31st, you can see that S&P 500 keeps moving higher, but this line is moving lower. That means money, even though the market is pushing up, money is flowing into defensive areas. So again, that's really not ideal. Now, if the market's moving higher and it's only been a couple days, and let's say the conservative stocks are outperforming, I don't throw in the towel. But typically, if you're pretty close towards the top and then you start to see, you know, the market's trading sideways, but this is starting to really curve down. That means money is rotating into staples, right? Your cereals, your cigarettes, your beer, recession-proof type stocks, that toothpaste that people are going to buy no matter what. That's an early warning sign. Again, you want to look at this price and volume first, but sometimes when I see this divergence, it really just means like, okay, I'm probably just going to hold off on new purchases for a little while until I see that sector rotation get a little bit better. So if we continue to come down here, the TNX, the 10-year Treasury yield, bond yields have been moving lower really for quite some time. Let me inspect this, kind of put a date on it. So bond yields have been moving lower, we'll just say right here, since May 18th. And now bond yields have always moved lower over very, very long periods of time, but what that's telling me is institutions are buying bonds. Right, they're rotating into bonds. All right, they're buying it up, pushing up the yield, or pushing down the yield, excuse me. And that's not a good sign. That's showing you money is, when the yield drops like this in the very short term, right, that means money is flowing into bonds. So this is another breadth indicator. This is a percent of stocks above the 50-day moving average for the New York Stock Exchange. Again, you can see on June 8th, so this was breadth was doing okay, but then on June 8th, that started to roll over. So really, you have the bond yields that started to roll on May 18th. You have conservative stocks that were starting to lead on May 31st. And then you have, last but not least, you have the breadth indicator was starting to roll on June 8th. And then you have the Russell 2000 was starting to underperform the S&P 500. So, but, you know, so you can kind of see these series of events, but again, these are secondary indicators. If I see the market breaking out, I'm going to start buying. And I'm going to put more money to work as long as I'm seeing aggressive areas lead. And for the first few days of the rally, and a few days before it, aggressive technology and banks were leading the charge. But it quickly fizzled out. It hit resistance, and that's why you got to be extremely careful. Don't be married to a breakout. Don't be married to a stock or a trend or anything like that. When you every day you have to wake up saying, I'm not going to try to predict the market. I'm just going to react to it. And if I see a divergence, I'm going to start paying attention, and I'm going to start planning accordingly to start to tread with caution. So, all right, so we have that. I want to look at the chart of the day, and this is something that was actually kind of eye-opening to me when I did this. Okay, so I'm going to try to... okay, so this is the VIX, okay? So we got the VIX right here, the Volatility Index. Now, right now, the Volatility Index is around 1975, so volatility is spiking. And I really learned this from a guy named Tom Boley from StockCharts.com. He always talks about the Volatility Index, the VIX, that level of 20. Once that level of 20 is breached, you really, really need to be cautious, because when that volatility starts to spike, usually it's harder to make money, right? And again, it's not saying you can't make money, but you want to put the odds so much in your favor that over time, you're the house. And the house eventually wins over time, right? Now, there's going to be periods where, the house might lose 2 or 3 times in a row, but you want, it's all about risk management, and we're trying to put the odds in our favor. And if you're seeing sectors starting to rotate into conservative stocks, and then the VIX start to spike, you really just need to be cautious with your trading unless you have a very specific game plan and it's working for you nicely. So what I did was I was like, okay, the VIX is spiked above 20 a few days ago, okay? On June 13th, it's June 17th today. So I'm like, okay, so what happened to the stock market the last several times the S&P 500 or the VIX spiked above 20? What happened after that spike happened? So you can see all these horizontal lines are times that the VIX spiked above 20 for the first time, right? So again, we're trying to see once it spikes above 20 initially, what happens in a relatively reasonable short period after the fact. So right now I circled these VIX spikes. Let me get this inspect off, right? Okay, so right now we have these circles, and that's when the VIX initially spiked above the 20. And a lot of times what happens is it spikes, comes back down, it eases, and then it spikes again. So right now we spiked, and we don't know what's going to happen because that was just a few days ago. But the last time the VIX spiked, right, we were in, now this is the S&P 500 right here. So I'm just trying to show you where the VIX spiked. So you have this nice trend right here. This was from September to early November. And then you had a really quick pullback in the market. That was your spike right there of 20. Now what happened after that is the market bounced, but it couldn't take out the high. And then it completely rolled over. So from this low right here to this low right here, there was an 11% drop in the market from the VIX from the time when the VIX breached the 20. So it's not an exact science. It's just a warning sign, because a lot of times what happens is once that VIX hits 20, then the market might bounce a little bit. The VIX will drop, suck everybody in, and then won't break out to new highs, and then it'll roll back over. Okay, so now let's look at the next one. That was the last one. So an 11% drop from the moment the VIX hit 20 to this recent low. But it bounced first, but it never broke. So, okay, now you have July of 2015, and this is the S&P 500. So you have, a correction. And a lot of times the market might have to correct, anywhere from 3 to 5% first before the VIX hits 20. So then you got this, right? And the VIX spiked at 20 right at this recent low. But again, it's a recent low. Then the VIX eased when the market bounced, because when the market bounces, the VIX will pull back. But you can see it never broke out. And then it completely rolled over from there. So a good rule of thumb is, one, if the VIX is above 20, you probably should just stay out of the market completely, because your odds of a successful trade, depending on the kind of trader you are, unless you trade the VIX, just lowered substantially, right? And we're trying to be the house, right? So if the VIX is above 20 and if it's staying above 20, you should just chill out for a while. Cash is a good place to be. But another rule of thumb is if the VIX spikes, and that's probably going to be your recent low, you really need to pay attention to see if it breaks out to the more recent high. And I would say the all-time high is right here. S&P 500 didn't touch it. It got very close to it, and I feel confident that as this bounce was happening, I feel confident that probably the sector rotation was more your defensive stocks, and then it completely rolled over. So there was a 9% drop from this low, not from this bounce, from this low to the low once the VIX breached 20, okay? So again, rule of thumb, make sure it clears. So if the VIX hits 20 and then you get a market breakout, you might have to buy something, but you might want to wait till, going all in until this level is cleared, okay? Now, so those are those case studies. Now you have, back in late 2014, December, you can see the VIX for the first time cleared 20. And it was pretty close to the bottom. It looks like after it happened, there was a 3%, maybe even a 4% continuation drop, right? So sometimes it's not always the low for the day or the week, but sometimes it continues to go, and then it bounces higher, right? But then, so then you're like, okay, now I'm going to, start to probably get in some here. I'm going to start to get in some here. And then it just completely chopped you up and spit you out in early 2015. And you can see the VIX keeps popping above this 20 level. So the likelihood, probably I think this is probably what I did, once I got a breakout here and I was buying more here, I probably got stopped out in here somewhere. But look at this choppiness. Like if the market just cannot start living, in the 15 to 17 area in the VIX, you probably just need to sit it out, because again, we're trying to put the odds in our favor. Same thing that happened over here. Now, October 2014, I'll never forget this correction. It was a really weird correction. You typically don't have just straight V-shaped corrections like this where it's straight down, straight up. But that's what happened. So you had a spike in the VIX above 20 right here, this line. But it just continued to flush out. The VIX got all the way to 31. So you probably continue to have, I'm just kind of doing some quick math in my head. It looks like about a 5% continuation drop after the VIX spike. So maybe you just get out and sit the sidelines and you wait for a breakout. Now the market broke out right in here, and I have rules. I started to get in, but honestly, I was shaking in my boots because I'm like, man, the VIX, and typically I thought it was a bear market rally. However, I had my rules. They got me into the market, and I made some very good money on this trend when a lot of people, including myself, probably thought it was a bear market, but those people were sitting, a bear market rally, but those people were sitting on the sidelines. So again, how can you put an action plan in place when you're playing the VIX? You just really have to watch that 20 level. And if the VIX is hovering around 20 or in 20, it's really important to pay attention and probably at least limit your new purchases. But again, you can, to see if the market bounces, if it clears new highs, and if it doesn't, you probably don't want to go fully invested until it does. That's just a really good rule of thumb. So, this was really interesting to me, and I could go back, even further, and I probably will once I started this research. Excuse me, I have to take a drink of water. I thought it was really interesting. It was really kind of eye-opening. So that 20 VIX level, that's really important. So that's kind of my chart of the day, and I hope you learned something from that. And the VIX isn't really something I paid attention to that closely until here recently, and I'm really just watching these 20 levels. And the more I get that 20 level is important, the more I'm starting to use it. Really just to stay on the sidelines and hold out for new purchases. Now, let's see. The market, you got the Nasdaq right now, and this is about midday on Friday. The Nasdaq isn't doing too hot. The Russell 2000 isn't doing as bad, so maybe money is shifting into more aggressive areas. But let's take a look. So you have energy sector is bouncing. You got utilities that are still up there, but technology is really not doing well, and that's not a good sign because you really want technology, your aggressive stocks to lead. You have cyclicals that are kind of the middle of the pack. Healthcare, I'm kind of interested. Biotechs, again, aggressive stocks. Yeah, I would say for the most part, you have a lot of aggressive stocks, and this is just today. They're towards the bottom of the pack. So let's look at 1 week. 1 week, utilities are leading, right? So when utilities are leading the market, again, you really need to pay attention to that because that means that someone with more buying power than us, a lot of people probably don't think too highly of this rally or don't think too highly that we're going to enter a new bull market. So they are preparing themselves for a potential correction or at least a market that's going to wear the living hell out of you. And that's, and that's true. That's what the market is going to do this year. It's going to wear everyone out. But if we, 1 week, let's see, 1 month, still utilities, consumer staples, right? Even the short and long-term trend, for the most part, like money is rotating. And you had a few days in there a couple weeks ago where money was just looking solid, rotating into the right areas. That's why you can't just ignore everything and buy your stocks and just go away unless, now I'm a fan of buying stocks, putting your stops in and not staring at your screen. I'm a big fan of that because it takes the emotions out, right? Making it mechanical as possible. But sector rotation can change very, very quickly. So I would, again, after looking at all the data, I would really be, we'll probably get a bounce here. I mean, we'll probably get a bounce. Let me kind of go back to the S&P 500. Right, and you can see out of the last several days, it can't retake that 50-day moving average. It's living under it, which is not really a good sign. It doesn't mean it can't break through. But I would probably expect a bounce and probably a better short setup than anything. But if we get a bounce and money continues to flow into the conservative stocks, then it might be a good opportunity to sell into. If you get up to this level, sell some of your stocks at a profit if you have them. Raise your stops to break even. Probably, again, that's if sector rotation is still conservative. That'd probably be just a great way to kind of get out, selling opportunity or shorting opportunity if you see fit. So let's look at some interesting charts. Okay. Now you have light crude oil right here. And this is yesterday, so I actually haven't looked at it today. But you can see oil went from $26 to 52. It literally doubled. Okay, that's a pretty big move. And honestly, there's been this retracement right here, but other than that, it's just been grinding its way higher. Now look at it. It broke the 20-day moving average, I believe, on Tuesday, and now it's kind of curling under it. Right, the price is staying under it, and now you have this 50-day period moving average that was tested back here, and you can see this double bottom breakout. Right, it broke out above $35. It hit resistance at the 200-day, came down and found support at the 50-day, then finally broke through. So you can see, this is why I use moving averages, because it's so clear as day to me where the support and resistance is sometimes. Like, look at this. You got resistance at the 20-day. It came through, it found support at the 50-day. It came back up, broke through the 200-day, but it came back down and found support at the 20-day. So if you understand and you've looked at enough charts, you can kind of play these to your advantage. I bought a little right here. I sold right here. I didn't buy back right here, just because I didn't know how hard it was going to come down. But it's looking like it's in correction mode. Based on the support that was found right here, is it reasonable to assume support we'll find right here? I think that's reasonable. I think it's okay to take a stab at some, oil or USO or some kind of oil-related stocks, but don't give it any room, right? If the market, if it breaks this level, you need to be completely out, no questions asked, because you don't want it to go from 46 to 41. Now you're looking at a 15%, potential fall there. Whereas right now you could look at it as only like a 2 to 3% potential loss if it doesn't hold. So I would just continue to, if you want to buy support, but you literally need to have it, your stop right under support. So now let's look at gold for a second, because gold, the chart's kind of looking ugly to me. That doesn't mean it can't move higher. I think, metals will probably do well if the dollar rolls back over, but look at this cup with handle, right? And this is a beautiful cup with handle right here. You got this cup, boom, handle. That right here, this breakout is probably the best entry on this chart. Did most people buy it here? No. Did I? No. I bought platinum as it was breaking out, and I made some pretty good money on that this year, but no. And then it moved up, and you can see how sloppy it is, right? Well, you had this breakout right here, this candle right here, and then it just rolled back down. Gold is acting kind of weird to me, and then you have this nice move, right? Just this uptrend, and then yesterday's candle, and again, this is yesterday's candle, is a little concerning to me, because you can see it tried to break out and then completely reverse lower. I would be blown away if within the next couple days the gold takes out this candle right here. Just because that reversing candle is so obvious and so ugly. I think that there's a lot of potential resistance around here. Maybe the market pulls in, finds support at this cluster of moving averages, and then takes off. But based on what I'm seeing, that's not really exciting to me. I'm glad I didn't buy this breakout. Typically, I don't like the V-shape bounces, right? You got a pullback and then a straight bounce, a breakout, and then the expectations of it really making a nice gain there after some of these breakouts of these V-shape are not really great. Now, this V-shape, maybe it looks a little bit better than this, but again, I can't ignore this candle right here. And you can see over here there was, some rejection at this price. And we could just go over. So you can see there's 2 or 3 reversing candles right around the 1300 area for gold. So I'd just be cautious when you're trying to really enter your miners, which I know everyone's excited about miners, but I'd be cautious because, if gold continues to find resistance at this 1300 level, and it might break through today, but you need to be aware of where the resistance is. Now we can look at some, whoops, excuse me. Yeah, see, I mean, this is Global X silver miners. Silver miners didn't break their 50-day moving average. Gold miners like GDX and RING did. But look at yesterday. You can see that this is a sloppy pattern. I mean, this is why I wasn't a big fan of getting involved right here, just because of the sloppiness of it. I mean, it's really been sloppy all the way, and sometimes that's just the way it goes. But you can see yesterday's candle right here. It tried to break to new highs and just completely reversed lower. So I think the miners are going to have to eat through that candle, eat through that resistance before it moves higher. And right now, and a lot of volume came in at these silver miner levels. So there's some resistance going on. So I'd be aware of that. RING. I use RING over GDX just because I've held them side by side over a short and long-term period, and RING just does slightly better. This is the iShares version. Same thing. Look at this candle. This is not. Look at all this volume that came in. This reversal that happened yesterday. So as far as gold miners collection as a whole, and again, this pattern is extremely sloppy. Like there's nothing easy on the eyes about this. Like it's something for me tough to get involved in. I would rather get involved in an emerging market country that's probably directly related to miners with a better looking pattern, maybe something a little bit smoother, which is what I have done just because of the sloppiness of this. That doesn't mean you can't make money, but over time, sloppy usually does not put the odds in your favor. And we're trying to put the odds in our favor. We're trying to be the house over time. So just something to pay attention to. Now, commodities are still looking interesting to me, and if anything, I've looked at the things I've made money on this year. Almost all of the individual. So I made a little bit of money on my trading system. It's beaten the market, even though the most recent breakout failed. But a lot of the things, the individual trades that I have made money on, they've all been related to emerging markets or metals or commodities in some way, shape, or form. Whether the energy sector, MLP, platinum, Brazil, other emerging markets, most of my trades have been in there. So I just want you to really open your mind and be aware that I think that if I think you're going to get chopped up, the market's going to chop most people up this year. I hope the market just rolls back over and wipes the slate clean. So, I can be sitting in cash and the market's correcting and then I'll buy the next breakout. But I just want you to be open to other things this year because that have to do with commodities, whether commodities directly or emerging markets. I just think that's it appears to me that's where the money is going to be made. UNG, this is pretty interesting because you have this long triangle, right? Bottoming pattern right here. It clearly broke out of this right here, and you can see it's kind of gone straight up, so it probably needs a pullback. But look at this sharp candle. That's kind of annoying. Let me get rid of that. Look at this sharp candle right here, and then this is just complete big move, and I don't know how much. Actually, let me see what the market was up that day. It didn't tell me the percent, but it was a big day, and then it's just tightly trading sideways. This 738 area is pretty much the same level of the 20-day moving averages. If it pulls back, and it pulls back in a neat and orderly fashion, this might be a good area of support that I would be looking to get into UNG natural gas because it clearly broke out of a bottoming pattern. We're going to have to see what it does with this 200-day moving average. I wonder if I can look at a longer chart to see how it has fared. Okay, so natural gas hasn't been above its 200-day moving average since mid-2014. All right, it just completely fell off. Something to pay attention to. Now, if all of a sudden it starts to break out and clears the 200-day moving average, I like to pay attention to things that are doing things they haven't done in a very, very long time. So UNG is really looking interesting to me. A lot of the miners are just not, the charts aren't really that appealing to me just because they're completely sloppy. I talked about Apple maybe it was a couple months ago, how it was a good short setup. So you have this line right here that it completely pierced, and I was talking about how 90 was, if it breaks that, it's probably going to come all the way down to 78 area. But it pierced it, and then Warren Buffett said he took a position in Apple, and then the Apple rallied. But look, it's still living under its downtrending 50-day moving average. This right here, I mean, it's just screaming to me that it's just gonna take this out, right? It's gonna continue, and this might be a decent shorting opportunity right here, just because everything's rolling over, the moving averages are rolling over. And everybody loves Apple, but this looks like one massive rounding top formation, and all the great ones fall. Whether they fall 50% and come back, it's every case by case different. But the 50, you get the death cross, and it just continues to try to touch its 200-day moving average, getting pushed back down, touching the 50-day moving average, getting pushed back down. So Apple, I'd stay away from it. And another interesting chart I'm looking at, and I'm looking at some bellwethers here just to kind of show you something. But Facebook's a good stock. It's got great fundamentals, but it broke its 50-day moving average. I believe that was on Monday or last Friday. But you can see it's sliced its 200-day moving average, but it's never closed below it. Right, in this whole monster bull market since it gapped up on 40 way back here, and it's never closed below it. So, I'm not a buyer right here, but if it's sitting on, if Facebook pulls back to 105 and it's sitting on this moving average, or it prints like a hammer right there, I'm probably going to step in and take a stab at it. I don't typically buy stocks at pullbacks at 200-day moving averages, but this thing has just shown some support over time. And, if this breaks the 200-day moving average, I think the market as a whole is just going to completely roll over. So I'm really keeping an eye on that. When I look at charts, sometimes when the market is looking ugly, I'll look at charts of growth stocks, like high-flying growth stocks that should be performing well in a good market. And the one thing that's kind of scratching my head is they haven't really rolled over yet. Right? Sometimes growth stocks are the first to go. They haven't rolled over yet. They're not looking ugly yet. So that's why I'm still kind of trying to hang in there and seeing if that S&P 500 can hold that 2,000 support. Because again, you want to look at everything. And if you're seeing high growth stocks that are just getting crushed and are slicing through support areas, that's a warning sign. But if the market's pulling back and that just hadn't happened yet, well, to me, that's a positive divergence. And I haven't really seen them. Facebook is an example, but a lot of the ones on my watch list, they're still hanging in there. And so that's not telling me that I'm just going to totally throw in the towel. But you also have commodities that are individual commodities that are looking really interesting. You have Joe, which is coffee right here. And you can see it's been November 2014 since it's been above its 200-day moving average. The red line, let's look at the one-year chart on this. Right, and it tried to break through. It came down. It really didn't find support anywhere. It just kind of slopped around, and then it broke out above this consolidation, reversed lower, and is now kind of hanging in there. So coffee is something that when it moves, it can move pretty quickly. Now, it's extremely volatile and it's extremely sloppy, but you have the golden cross right here. So, pay attention to commodities. Corn, I'm open to trading these things just because they are starting to get out of a long-term bear market. And equities might be entering one. I don't know. But again, you have corn that tried to break through. It came down, and then it kind of ate its way through and then broke out again. And now it's holding this 20-day moving average. So, again, these commodities are really starting to perk up, which is going to help emerging markets. I'm still looking at a lot of these emerging markets as some long-term investment opportunities, short-term investment opportunities, and commodities, some individual commodities. And you can easily go here. I'll scroll down here. You can easily go to go to the home page And this market summary right here, and this is free on stockcharts.com, and you can just keep an eye on, it's got a list of all these U.S. indexes, everything from REITs to natural gas. You can get a list of emerging market ETFs, bonds, commodities, so you can really pay attention to what's going on within them. Now, this is just kind of an end of day, but it's really a good list. It's a really good starting point. So, what am I doing right now? I'm really just waiting. Slowly been moving out of some stock. But I'm going to see if the market can provide a positive reversal with positive sector rotation. Just kind of playing it, right? And you want to make sure that I try to hang in there as long as I can, because the market always has a long-term upward bias, right? There might be 2 or 3 years where it just frustrates the living heck out of you, like it has now. But I try to hang in there until it's just completely, there's no other choice to get out, and then I'll get out. But I hope this was helpful. I hope, again, all the wonderful fathers out there, I hope you guys have a great Father's Day weekend. Let me know if you have any questions.